Topic examines the functions of dealer banks, which play a central role in modern financial markets by facilitating trading, market making, financing, and liquidity provision activities. Dealer banks act as intermediaries between buyers and sellers in securities, derivatives, foreign exchange, and fixed income markets. By continuously quoting bid and ask prices, dealer banks provide market liquidity and support efficient price discovery. These institutions also assist clients with hedging, investment management, underwriting, and structured financing transactions. The topic emphasizes that dealer banks are essential to the functioning of global capital markets because they connect investors, corporations, governments, and financial institutions while supporting trading activity and market stability across multiple asset classes. A major function of dealer banks involves market-making activities, where banks maintain inventories of financial instruments and stand ready to buy or sell securities on demand. Market making improves liquidity by reducing transaction delays and narrowing bid-ask spreads for market participants. Dealer banks assume inventory risk because asset prices may change while positions are held. They therefore rely on sophisticated risk management systems to monitor market exposure, funding needs, and counterparty risks continuously. The topic explains that dealer banks also provide leverage and financing through repurchase agreements, prime brokerage services, and securities lending transactions. These financing activities support trading strategies, hedge fund operations, and broader market liquidity within the financial system. The topic further discusses the importance of dealer banks in derivatives and over-the-counter markets. Dealer banks design customized financial products, facilitate hedging transactions, and act as counterparties for swaps, options, forwards, and other derivative contracts. Through these activities, they help clients manage interest rate risk, currency exposure, commodity price volatility, and credit risk. Dealer banks also contribute to market efficiency by distributing risk among participants with different risk preferences and investment objectives. However, these activities expose dealer banks to significant market, operational, legal, and counterparty risks. The topic highlights that strong infrastructure, collateral management, and risk governance frameworks are therefore essential for maintaining dealer bank stability and market confidence. Topic also focuses on liquidity concerns for dealer banks and the policy measures designed to mitigate associated risks. Dealer banks are particularly vulnerable to liquidity stress because they depend heavily on short-term funding markets and collateralized financing arrangements. During periods of market uncertainty, funding providers may withdraw liquidity, increase collateral requirements, or refuse to roll over financing. Simultaneously, declining market liquidity can make it difficult for dealer banks to sell assets without significant losses. The topic emphasizes that liquidity pressures can escalate rapidly because dealer banks operate with large trading inventories, leverage, and interconnected exposures across multiple markets and counterparties within the global financial system. A key issue discussed in the topic is the interaction between market liquidity and funding liquidity within dealer banks. When asset prices decline or market volatility rises, dealer banks may face margin calls, collateral haircuts, and reduced access to financing. To meet these obligations, institutions may be forced to liquidate assets quickly, further depressing market prices and intensifying liquidity stress. This feedback mechanism contributed significantly to financial instability during past crises. The topic explains that dealer banks therefore maintain liquidity buffers, diversify funding sources, and conduct rigorous stress testing to evaluate resilience under adverse conditions. Effective liquidity management is critical because dealer banks occupy central positions within financial market infrastructure and systemic liquidity networks. The topic concludes by examining regulatory and policy measures introduced to strengthen dealer bank resilience following global financial crises. Regulatory frameworks such as Basel III impose stricter capital requirements, leverage constraints, liquidity coverage ratios, and net stable funding ratios to reduce excessive risk-taking and short-term funding dependence. Central clearing requirements, enhanced collateral standards, and stress testing programs further improve transparency and risk management practices within dealer bank operations. Regulators also monitor interconnectedness and systemic importance to identify institutions whose distress could threaten broader market stability. The topic emphasizes that balancing market liquidity provision with prudent risk management remains a critical challenge for dealer banks, regulators, and financial systems worldwide.